Yeah, so as Ken said, this is usually stuff we talk about at the Clearstone partner meetings. So I would like to just go into a few things that happened this week. Obviously, there was the General Motors IPO, which we all know about, and big deal, third biggest IPO of all time. It got me thinking a lot about the IPO market. Some of you might remember about a year ago we were talking about it here, that in fact a lot of the mythology around IPOs in the past few years has been you can't take your company public anymore unless it's multi-$100 million in revenue, it's been around for a while, profitable, and as I said then, and I think it's come to pass, that was rapidly changing and in fact was never really true anyway. Although I think a lot of people in Silicon Valley still believe it. So General Motors went public, third biggest IPO of all time, which is great. By the way, if someone had said to me just a few years ago that the two noteworthy IPOs in 2010 would be automotive companies, one backed by venture capitalists and one backed by the federal government, I would have been very surprised. But that's
Tesla's up 60% from its initial IPO.
Yeah.
That's awesome.
Yeah, Tesla is up, you're right. And so there's a whole bunch of good stuff going on in the IPO market, which I'll talk about in just a second. But the real question is, why is it last year, when we were talking about martial law, the financial markets collapsing, and the entire world economy going into potentially depression, why do we now have IPO fever? And I think the reason is really simple. Everyone is chasing some returns, and there are very few returns right now, very few places you can get returns. Consider, of course, that the Fed right now has interest rates at about zero, which reminded me of why California, we all know is basically bankrupt, was able to issue debt this week at 1.75%. Now, that doesn't sound like very high interest rate, and it isn't. And you have to ask yourself why it is that a group of investors would buy securities yielding 1.75% when California is publicly stated it can't pay its bills, its infrastructure is collapsing, and we have a tax rate, keep in mind, it's already at 10%. So it's not like we can double the tax rate here to pay for all of the deficits in California. And I think the reason, of course, is because well, one, Fed is issuing debt at basically 0%, and the other is the unfortunate byproduct of last year's financial problems, which is that there is a too big to fail mentality now that pervades most of how people think about businesses in America, and certainly how they feel about governments. So while California has a lot of debt, I think the market believes that the White House will never let it default. Good for us in California, bad for everybody else. So why is it then that the IPO market is hot? As we said, you've got people chasing yield. I also think you have in China right now and in Asia overall a really interesting dynamic. If you compare the IPOs in Asia with the IPOs in the US, it's really interesting. The IPOs in Asia, the biggest IPO of all time, by the way, happened this year, which was Agricultural Bank of China, $22 billion of capital raised. The biggest IPO in Hong Kong, which was AIA, which is an insurance company. The biggest IPO in Japan in the last 10 years, Daiichi Insurance. The biggest IPO in Australia in the last 12 years, QR Natural, which is a commodities company, processes coal. And then, of course, the third biggest IPO of all time, General Motors in the US. But if you look at the IPO makeup in Asia, it's basically two things. It's banks, insurance companies, pretty much, those two, and maybe some commodities players. But think about what the IPOs are in the US, which I thought it was really interesting. So the two noteworthy ones that have filed that haven't gone public yet, Skype and Demand Media, and then a whole bunch of other IPOs that everybody's super excited about. Facebook, Twitter, Zynga, Gilt Group, Groupon. I mean, these are all, if you take a look at the two, they're all advertising supported, kind of mass consumer oriented businesses in the US versus the deep infrastructure, commodities and financial services in China. And so it makes you realize the world, or at least the investors in the United States, still believe that it's the American consumer that's really going to drive economic growth in the U.S. It's not going to be clean tech and a lot of other things we all hope. Which means, of course, that venture capitalists who tend to follow these trends are all trying to get into those deals. So this past week, some of you might have heard that two interesting articles, one about Twitter, the other about Groupon. So Twitter wound up raising, whatever it is, $100 and so odd million in the past year or so. But there was a rumor that it had been approached by Google to be acquired for between $2.5 and maybe $4 billion, which someone at Twitter said had been rejected because the offer was insulting. Which I found. All right. Then, by the way, Twitter was formed, what, 2007? Yeah. Then you have Groupon, which apparently is entertaining offers from Google of about $3 billion to $4 billion. And they're holding out saying they don't feel like that's an attractive enough offer. It really reminds me of the dot-com bubble era again, where, oh, by the way, how's Twitter going to make money? We don't know yet, but back in the dot-com bubble days, if you asked about revenue models, that was considered vulgar conversation, right? I think we're sort of back to that era, where do not ask Twitter how they're going to make money. They're a mass market phenomenon. So we have those two things going on, which of course has created a whole bunch of venture capital fever and desire on the part of VCs to get in these types of deals. The things that are noteworthy about those two companies, Facebook, of course, actually it's been around since 2004, so relatively it's a pretty mature company. But Twitter and Groupon, these are companies that barely existed a year ago. And the idea of them going public, which is one option they can do if they don't want to get acquired, to me is a very scary idea, because I wouldn't want to be in a company, I wouldn't want to be the CFO of a company that had only had a 2 or 3 year operating history, didn't really know what its long-term revenue model was going to be, and you consider Groupon, great interesting company, but what we don't know is what are the legs for a business like that.